Hey guys, welcome back to another video. Today I will be covering a topic which I've become recently interested in. Over the past summer, I've been working on learning about the real estate space and the real estate asset class. As a fundamental investor, I've been investing in stocks for quite a few years now, but I feel that I am lacking in knowledge and experience when it comes to one of the probably the most fundamental asset classes in the developed economies, especially in North America, which is real estate. And so today I'm going to be covering a topic about master lease option contracts. And so this is one way to structure a real estate deal. So we'll go through it. We'll kind of talk about an example. And then hopefully if you have any questions, I do recommend that you comment in the video and I'll be sure to get back to you with what knowledge I do have. Okay. So what is a master lease option? Now, there are many ways to structure a real estate transaction, and the master lease option is one creative way. Now, a master lease is a controlling lease under which a leasee can sublease the property for a period not exceeding the set term of the master lease. So consider a property, and we have the building owner, the owner of that respective property. And that, as with a car or any other type of asset, if you are the owner of that asset, you can lease out that asset if you're interested in such an income stream. And so the master lease guarantees that you are next under the building owner. So by saying that you're taking out a master lease, that means that person who sets that master lease can then also sublet once again. So they can go and they can find other tenants, and then those tenants can sublet those as well. So it goes down, right? You can go into further different tranches and subleases. But at the end of the day, your master lease is the highest priority leasee in that respective property, right? So that's what the master lease is. Now, an options contract is an agreement between a buyer and a seller that gives the purchaser of the option the right to buy or sell a particular asset at a later date at an agreed upon price. And so we usually hear option contracts when talking about derivatives and in finance. And so a lot of finance students might be familiar with that. But option contracts are not just limited to stocks. They're limited to any investment asset, including real estate. So just as you would set up an option contract for a stock, you can set it up for a real estate deal. So the underlying asset, which is that property, you can set up an option contract for which expires in 1 year. And say, for example, in this 1 year time period, you pay a premium of $5, or say for example $5,000, and you can exercise your right to purchase the property at a $1 million set price, regardless if it goes up or down. So that's your set price, and so you have the option to exercise that purchase. Or on the reverse end is a put option, but those are different in the real estate sense. But when it comes to option contracts, usually you see more call options in real estate. And so the master lease option combines these two terms. So it combines the master lease, which is you have the first priority, the highest priority leasee and for that respective asset. And then you have the option contract, which is built in at the end of the day, where if you want to exercise your right to acquire that property, you can define it from today at a set price in the future that you can purchase the property 5 years from now for X amount of dollars. And so that really is what a master lease option is. You decide to take out a lease. You are the master leasee, so you're the highest, you have the top priority, and you can do whatever you want with that property afterwards if you want to sublet. And at the same time, in addition to you paying those lease payments and then you generating additional income if you want to sublet or just take that lease and use that building yourself, you can also build in an option, right? And so the option is that you can purchase that property at a later date. So that is what a master lease option is. And I think the best way to understand that is to go through examples. And so we will go through a real world example. Now, an example of a master lease option agreement is, say, for example, you have a 4-unit property. You can take out a master lease for 5 years. So that is defined as the term. Each month you pay $500, so that is your lease payment, which is paid every month for the 5 years for the term. And then at the end of the 5 years, your option side of the master lease option agreement is that you can exercise your right to purchase this property for $1 million, even if it's worth $7 million on the market 5 years from now. That's your exercise price, and that's what you can purchase that property at. So that's really what the agreement is. Now let's look at a real world example. So let's consider a multi-family property listed in Toronto. So I'm based in Canada, in Toronto, Ontario. I looked at just a random multi-family property. I looked up on the listings, and I found that this is probably a relatively simple example, seeing that there are a lot of even numbers and it's not that complicated. So this is a multi-family complex. It has three-bedroom units, and it is currently listed as of May 25th, 2017 at $2.3 million. So that's the market price of this respective property. And this site offers you the projected assumption that your monthly mortgage payment will be about $8,000. Okay. Now the current owner, just a little bit of background information on this income property. The current owner of this property also initially invested in this property as an income opportunity to generate cash flow. And so the current owner of this property earns around $3,000 a month for each of the three-bed units. Now this is hypothetical. I'm not too sure what the actual real numbers are, but we'll keep it simple. Now this is below, we'll assume that it's below the market average due to a unmotivated landlord, maybe facing liquidity constraints, or he's getting old and doesn't really want to manage the property anymore. So really he's not performing to market expectations, and he's not actually maximizing the potential cash flow from this property. Now, there's an opportunity here, right? You could buy this property. Now, let's assume that the average three-bedroom unit of similar quality in that area charges about $3,500 a month relative to what the landlord is currently charging of $3,000. So with that, we multiply 3 times 3,500, a little back of the envelope kind of calculation, and we're assuming that each month it will generate about $10,500. And with a mortgage payment of $8,000, if we purchase this property and we take out that mortgage, assuming that we do pay that $8,000 a month, then all of a sudden we have an expected profit of about $2,500 a month. That's great. That's an amazing deal right there, and you add a few of those to your portfolio and you have some steady passive income. Now, there's a problem. Say, for example, I'm considering this deal. I'm in my 20s. I don't have that much money to really pay a down payment. And so once again, I'm in Canada, and in Canada, the minimum down payment is 5% for a home. For down payments of less than 20%, home buyers are required to purchase mortgage default insurance. So assuming that I don't want to pay the additional insurance costs, I need to put up 20% of the total acquisition price in order to get a reasonable mortgage. Now 20% of a $2.3 million property is $460,000. Now how do you expect me, a 22-year-old, to have $460,000? It's difficult, right? And so if it seems unrealistic to really acquire such a property under traditional terms of just taking out a mortgage, buying it, and then renting it out. But there are other ways, and this is what the master lease option agreement does. It's a different type of way you can structure your deal where you don't need equity to acquire this. You don't really need to invest your own savings. Again, assuming that the market is stable, you can walk in there with zero equity and you can set up a deal. And so let's take a look at that. So the seller is currently firm on the $2.3 million price tag. However, you suggest a master lease option agreement. The terms are a 5-year lease. And so we're assuming that, we go up to that seller and we tell him, look, I'm going to guarantee you what you're currently making, which is 3 times $3,000, so $9,000 a month in lease payments. You don't have to worry about the tenants. You don't have to worry about the maintenance expenses. You are guaranteed that $9,000. And especially for someone who's unmotivated and who doesn't really want to get involved anymore, that's a great deal. The standard of earnings does not fall at all. He's earning what he's assuming he will earn in the future with less work, right? And in addition, I set up an option in this agreement to buy the property to have the option to buy the property in the next 5 years for the current asking price of $2.3 million. Okay? Now, with about $110,000 in renovations, I assume and I'm confident that I can improve the property's cash flow by increasing the monthly rent on units and attracting higher paying tenants. I assume that, I think I can get $3,500 out of this. I can actually hit that market average, which we talked about, right? By investing this $110,000 in renovations, making any changes that are necessary to really improving the quality of these units, I believe that I can raise rent and also continue to increase it over the next 5 years in order to really generate some positive cash flow and profit from this deal. So in the end, looking at the market and after much due diligence, I decide that, both me and the seller decide on the stated terms of the 5 years at $9,000 a month in lease payments, with the option to buy the property whenever in the next 5 years for $2.3 million. And so we agree that for the next 5 years. Now I project the performance of the property under great terms, right? So let me just walk you through this. So this is the master lease schedule, and so we have a timeline here of 1, 2, 3, 4, 5 years, and we have here the rent, the monthly rent. So in year 1, I am assuming that after I invest that $110,000 in improvements, I invest in, I change, kind of replace different things, I will raise rent and I will charge the 3 tenants in each of the 3 units $3,500 a month. And I also assume that with these improvements, I can increase rent by 5% each year. So as you can see, the top line, the first line right over here. So in the first year, $3,500, then a 5% increase, and so on and so forth, right? Now, I'm assuming that I have 3 out of 3 units. I'm assuming that in each of the 5 years, I'm a great salesman and I can find tenants who are going to demand and want to use my units, right? To want to live in my units. So I'm not assuming that I'm going to have problems with occupancy. And that's a big assumption to make, but for simplicity's sake, let's assume that all 3 units are being employed. Now, multiplying that by 3, so $3,500 by 3, we get monthly rent earnings of $10,500, okay? And then multiplying that by 12, I'm assuming that my total yearly rent earnings will be $126,000. Now, the annual lease payment, the $9,000 times 12, is $108,000, right? And in addition, I'm assuming maybe an annualized maintenance expense. I got to send in a contractor. Maybe he's got to paint something. Maybe he's got to fix a broken sink of about $2,000. So my net yearly cash flow when accounting for the earnings minus the 2 expense lines is, in the first year, $16,000. In the second year, it's about $22,300. $22,300, then in year 3, $28,915, and so on, right? And if I were to sum up all 5 of these, net yearly cash flow years, I get a total of about $146,229. And that's a great deal. So I'm getting positive cash flow yielding each year. Now, this is in a stable market, assuming no significant risks and changes. But this is how you would really approach a deal. When you look at such an agreement, you want to assume that, okay, my master lease, I'm going in there, I'm negotiating with this property owner, and I'm saying that my lease payments are going to be X amount. They're not going to increase relative to what he could earn. They're going to be what he is currently earning. And then I need to recognize that this property has some opportunities. If I invest a little bit, I can add value and therefore increase the amount of rent that I charge the tenants that I am subletting to as the master lessee, right? And so that difference between what I receive from my tenants and what I have to provide as a lease payment is really the profit that is generated on this master lease, right? And all of a sudden you become an investor, someone who benefits from, cash flow on this property, even though I don't even hold a single percentage of equity. Okay. Now, the big expense which we included in that schedule was the $110,000 in renovations. Now, as a Canadian resident, with American investors, it's a little different. But with Canadian investors, a cool thing is that all interest payable on investment loans is tax deductible. So the interest that is charged on, in this example, the $110,000 invested, a considered investment loan invested in this property, is tax deductible. So we can even benefit more. So say, for example, we take out an investment of $110,000 invested in this property at an annual interest rate of 4%. Now, annually, we pay about $4,400 per year in interest. This is deductible from our reported income. Now, a way to really calculate, the net or savings that you get from this tax deduction, we multiply the amount deducted by the tax rate. So 27%, we're assuming that a random number of 27% by $4,400, we save in this scenario $1,188 every year because of this deduction. We're assuming that, we're paying off this loan across this 5-year period, and we're assuming that, we're making coupon, we're making the payments, we're making interest payments, and then at the end we'll pay back the principal in full. So where it's not a blend of interest plus principal. It's just interest for 5 years, and then at the end of that 5-year period, we're also paying down the full principal, right? And so in that way, we're assuming that, okay, we're saving, in addition to the cash flow that we're generating, another $1,188 in tax savings. Okay, and now we can actually add that back in. So going back to the master lease schedule, we have the monthly rent, the units occupied, the monthly rent earnings, yearly rent earnings, nothing changes. We also have the expenses, so the annual lease payment to the owner and the annualized maintenance expense. In addition, we have annual tax savings. So we have our net yearly cash flow plus annual net savings. Tax savings, right? And so if we were to add up all of these cash flows, we get a total 5-year cash flow of $152,169. Now, these are all random numbers, essentially to kind of display to you how the thinking works behind a master lease option agreement. Now, to really make it realistic and also to account for the time value of money, saying that, a dollar earned today is worth more than a dollar earned 2 years from now, we need to discount the future earnings, right? So even though we might be if we're in year 0 right now, well, at year 5, this $43,000 is not going to be worth $43,000 today. We got to discount it to the future. So that's what we did. So we take the same net yearly cash flows and annual tax savings. We add them up to get our total cash flow for each period. We then calculate the discount rate using the 4% interest rate, assuming that, that is K is the discount rate, to get a present cash flow value of $16,526 and so on for each of the years. So we discount them to the present, and then when we sum that up, our net present value earnings is actually $133,119.50. So that's the net present value earnings. So this is different from the total 5-year cash flow earnings. So here we're assuming only in future value terms. So we're not discounting it back to the present, back to year 0. And so in those terms, the total cash flow earnings is $152,000. But when we're discounting it back to the present, as the time value of money works, it lowers it in order to account for that time value of money. So it's now the net present value earnings of $133,000, accounting for the investment spend of $110,000, assuming that we're seeing that we've taken out that loan today. The present value of that loan is what we've taken out, right, of $110,000. The difference and really the profit that we walk away from after the 5 years, simply by making that investment, increasing the value added and increasing the cash flow of the property, and then reaping the rewards after 5 years, is $23,119. So that's the profit simply by setting up a master lease option agreement, recognizing an opportunity in the market, taking out an investment loan, increasing the value added, which results in increased cash flow from the subtenants in that respective property. And then the difference between what we pay in lease payments and what we receive from our tenants is, in discounted terms, this. In year 0, in discounted terms, the net profit, the expected net profit, would be $23,000. And without a single dollar of our own equity invested in that deal. That's what's so amazing about this deal. And I really love learning about these different structures. Hopefully I can make more videos about this, but this is a very, very unique and I would say unknown way of really structuring an investment deal. And you should really get interested if this sounds appealing, okay? Now, as you can see, through a master lease agreement, you can leverage an investment loan and tenant improvements to realize a sizable gain with no equity invested in the property. This is a great option for real estate investors who may not have the initial funds to purchase equity. But don't forget about your option, which expires at the end of the 5-year term. So let's go back to the same property and assume that after further development in the neighborhood, the property is also worth $3 million in the year 5. So with the option to buy for $2.3 million, you are now in the money and you could exercise the option yourself and realize the $700,000 gain, or sell the option to a willing buyer, albeit at a discount. So That's another added benefit. It shouldn't be the core driver of profit in this respective case. You shouldn't be taking a loss on your cash flow in order to just get a cheaper option. Really, this is just the cherry on top. This is what happens, and it really provides a lot of flexibility. This is what's really amazing about this structure, because you're investing in this, you're recognizing value added, and at the same time, if the market improves and the region around that house or that property also becomes more modern and more valuable, then all of a sudden, not only are you realizing monthly positive cash flow, but you're realizing a positive capital gains when you do exercise your option. Now, in our respective case, if we have $0 of equity that we can invest, we can also set up a double closing, which is the simultaneous purchase and sale of a real estate property involving three parties: the original seller, an investor, us, and the final buyer. This allows the middleman to use the purchaser's funds to acquire the property from the original seller. So in our example, the purchaser would pay $3 million, which is the current market value for the property. The funds are transferred to us, which within a short period of time of a day or two, we go to the current owner and exercise our option, and we end up walking away with $700,000 in cash plus the remaining yearly cash flow funds. Once again, with no equity invested. Again, that's the best case scenario. And so looking at the advantages of master lease options, we put less money down out of our pocket. We talked about this. In our example, we decided to use all borrowed money to improve the property, and with double closing, we never use a single dollar of our own cash. In addition, it is cheaper than hard money. So instead of buying and building outright and paying monthly mortgage fees, usually the lease payments are lower and offer an advantage relative to the monthly mortgage payments if you were to simply buy out the property initially. In addition, less money is at risk. So we don't expose ourselves to any equity loss if things go to plan, and we'll talk about the risks. And in addition, there are different tax advantages for Canadian and US investors. So I would recommend that you look up for your respective state or for your respective province how this investment scheme would work, and if there are tax advantages that you can take advantage of. Okay, now what about the risks? Well, number one, the building owner may fail to pay mortgage payments on the building. So in our example, if that owner for the $2.3 million property still had a little bit of mortgage to pay, and he was facing those liquidity problems and all of a sudden couldn't pay for the mortgage, then you end up in a scenario where, the bank could foreclose a property, and all of a sudden I really could not lease it out anymore because it's the banks now. Now, of course, there are ways you can structure the contract to protect yourself against that. But at the end of the day, the owner, if he acts in an ethical way, should take a majority of the lease payment that you are making and put that towards the mortgage while taking any added value and using that for his personal use. Okay, there are different assumptions that can go wrong as well. The occupancy rate can be lower, the tax rates can change, interest rates and the cost of debt can change. There can be excess maintenance fee. There can be a horrible flood in the basement, and that will cost $20,000, and that will completely ruin your cash flow. Now, if things do go wrong, you could end up losing every month for the length of the term when lease payments exceed cash flow earnings. So when you lock yourself in this contract, well, when things are going well, yes, you realize that added value every month. But if things are going bad and the lease payment is higher than what you're earning from your tenants, then every month you're losing money. And so that has to come out of your own equity, out of your own savings. You may also overestimate the value-added efforts you planned. So when you initially look at that property and you're like, hey, you know what, I could increase it to $3,500 a month in tenant income. Well, if you really buy the property and you kind of take it apart and you look at it and it's like, oh man, this is going to cost me a lot more, or oh, maybe I was really wrong, I didn't assume that I needed to change that, and all of a sudden, really, you might overestimate the amount of value that you can add. So you got to really be confident and experienced in really adding value to especially commercial or multifamily properties. In addition, there can also be, as always, external shocks to the market. Buying demand or selling demand could fall off a cliff, and all of a sudden you find yourself in a scenario where you don't have tenants to really fill in those units. Okay, so as always, the next steps, please do your own due diligence. This was just a general kind of primer video, and seek both professional and mentoring help on whatever deals you may pursue if you are considering this structure. In my opinion, the best resource is biggerpockets.com. I'll provide a link in the video description, where many real-world investors share their experiences using master lease agreements, and that's how I came across this structure. I was listening to not only a podcast but reading some articles, and I just as any other investor, I thought about just just a general mortgage structure, but there are a lot of different structures, and Bigger Pockets talks about those options. So as always, if you did like this video, I would appreciate that you like and subscribe to the channel for more. And if you have any questions, please comment below and I'll be sure to get back to you as soon as possible. Thanks, guys.